9 common mortgage myths that can prevent people from pursuing or getting approved for a home loan. Myth number 1, you need a 20% down payment. While many people believe you must have 20% of the home's value saved up for a down payment, you don't. The only reason they say that is because putting down 20% can help avoid what is called private mortgage insurance, or PMI. There are loan programs such as FHA loans that allow down payments as low as 3.5%, and some conventional loans with a down payment as low as 3%. Myth number 2, you need to have perfect credit to qualify. Most people think they need a perfect score of 750 or higher to qualify for a mortgage. That's not true either. Most lenders offer loans to buyers with credit scores, get this, as low as 580, and those are for FHA loans. And many conventional loans may be available with scores starting around 620. Myth number 3, all debt is bad for mortgage approval. Nope. Some people believe that having any kind of debt like student loans or car payments disqualifies them from getting a mortgage. Lenders are going to look at your debt to income ratio, or DTI. Not just your total debt, but your DTI. Having some manageable debt is often fine as long as your DTI ratio is within acceptable limits, typically 43% or lower. So, myth number 4, you can't get a loan if you're self-employed. Well, guess what? People think that if they're self-employed or freelancing, they can't qualify for a mortgage. Believe it or not, self-employed individuals can absolutely qualify for a mortgage, but they may need to provide additional documentation like 2 years of tax returns and consistent income history to prove their earnings. Myth number 5, pre-approval guarantees a loan. Nope. Some home buyers believe once they're pre-approved, they're guaranteed the loan. In reality, a pre-approval is not a guarantee. It's an indication of how much you may be eligible to borrow. I do a webinar on this. And based on your initial checks, finally, approval depends on a more thorough review, including updated financials, property appraisal, employment verification, etc. Number 6, only first-time home buyers can get special assistance. Nope. Many people think only first-time buyers qualify for special loans or down payment assistance programs. That's not true. While first-time home buyers can't access specific programs, there are also down payment assistance and special loan programs available to repeat buyers as well. Myth number 7, interest rates are too high, so it's not a good time to buy. Well, guess what? Potential buyers might avoid applying for a mortgage because they believe interest rates are too high. While interest rates fluctuate, even though the Fed's lowered it by 0.5 percentage point, it's going to take 2 months to trickle down. They're not the only factor in deciding whether to buy. Refinancing later is always an option, and the long-term value of home ownership can outweigh temporary rate concerns. Myth number 8, you should only get a fixed-rate mortgage. Some believe a fixed-rate mortgage is the only safe option, while fixed-rate loans offer stable payments. Adjustable rate mortgages, or ARMs, ARMS, can offer lower initial interest rates, making them a good option for people who plan to sell or refinance within a few years. I had an ARM before, and it was only for a few years because I was going to sell. And then myth number 9, you can't get a mortgage after bankruptcy. Some people believe if you file bankruptcy, you'll never qualify for a mortgage. While bankruptcy affects your credit, you can still, believe it or not, qualify for a mortgage, typically after waiting a period of maybe 2 to 4 years. It just depends on the type of loan and bankruptcy chapter that you file. So by understanding these myths, potential home buyers can now confidently approach the mortgage process and make an informed decision.